Hello everyone. So today in this session we are going to start with two chapters set. One is leverages, another one is capital structure. As I already said, three chapters will account for 20 to 22 marks in exam. Capital budgeting, capital structure theories and leverages. Okay. So once those chapters are completed, substantial, already we completed three chapters. Now these three chapters said once we complete, substantial 80% of the portion from the point of view of a marks will be completed. Okay, in-depth discussion we are going to make in these three chapters now. First I am going to start with leverages read with capital structure theories. Sorry, first point number one. Everyone will get one doubt. Why I should interconnect both the chapters, capital structure and leverages, or leverages and capital structure? Is there a need? Is there any reason? Yes, there is a reason. In leverages, we will understand about financing and other related items. In capital structure theories, we will discuss about optimum financing. What is financing we will see in leverages chapter. How much financing is required we will see in capital structure theories. Leverages and capital structure theories chapter both are called as financing decisions. What they are called as financing decisions. Okay, now I am going to discuss leverages chapter and capital structure theories chapter in three parts again. Part 1 leverages, part 2 EBIT EPS indifference. Everyone repeat, what is it? EBIT EPS indifference. One concept is there. So what is this EBIT EPS indifference? This point of EBIT and indifference concept we will see in capital structure theories in institute study material. That itself we will divide and I will keep it as a separate chapter where we will be doing around 4 to 5 problems, but theoretical discussion is very big. Okay, theoretical discussion will be very big. There we will understand EBIT EPS indifference curve, how that curve is formed, what is the concept, everything we will see there. So therefore listen carefully why these two chapters are interconnected. EBIT EPS indifference curve concept is one of the most important concept in capital structure concept. That EBIT EPS analysis, what is EBIT, what is EPS, how EBIT impact EPS, what is the need to understand all these, we will see in leverages chapter. After learning about what is EBIT, what is EPS, understanding the indifference will be seen in capital structure theories. This is second part. Third part of capital structure theories is net income approach, net operating income approach, traditional approach, like the stochastic approaches, like that 4 or 5 approaches on capital structures are there. Those are the basic concepts which we will see. So leverages and capital structure is one of the most important chapters in your syllabus. Both will account for around 12 to 14 marks in exam. Capital budgeting will be for another 8 to 10 marks. Okay, 8 to 10 marks. Ratio analysis chapter will be there. After this, that chapter will account for 6 marks and working capital also will account for 6 marks. So those two we will keep at last. First we will complete all these. Means in the 60 marks, first we need to complete 48 to 50 marks syllabus. With these three chapters, that itself also will get completed. So summary is, we will be now doing three chapters. Okay, in these three chapters, the first chapter is leverages. Leverages will be covering out all the basics related to these two other chapters. To understand capital structure theories, to understand capital budgeting, la financing decision making along with investment decision making, to understand this chapter leverages will play a crucial role. I will not tell a basic role, it's a crucial role. My dear friends, I am telling you very clearly, if you miss listening to leverages chapter, it's a nonsense to listen capital structure. Capital structure chapter can't be read independently without support of leverages. Leverages chapter is the foundation, the base for capital structure theories. So therefore with that intent, I am first making leverages basic lecture now. Basic lecture does not mean basic nonsense discussion. This is a theoretical discussion for around 2 hours, which will support you to understand the entire concept of leverages. Okay, so therefore this is the leverages first lecture. We will be totally having 2 lectures on leverages, small chapter but gives a curious result. So first we are going to do theoretical discussion that will take a lot of time to understand. Once that is made, once everything is completed, then we will be jumping into the next area called as a practical. There are totally 11 problems with us. Those 11 problems, if you solve confidently, you can go to the examination. Any kind of question you can ask, you will be able to answer. Am I clear? So therefore, with that intent, let's start discussing the chapter leverages. Okay, so now let's start. Let me first give you the learning objectives of this chapter. See the screen. Learning objectives. First, understanding income statement. Understanding income statement. Next one, concept of risk. Concept of risk. Analysis on various types of risk. 2 types: business risk, finance risk. Concept of leverages. Analysis on various types of leverages: operating leverage, financial leverage, and combined leverage. Other miscellaneous issues in leverages chapter. Okay, first everyone copy down the learning objectives. Once you copy this, we start with the discussion. Completed? Now, first one, let us see how much discussion we have to make. After that you decide. Okay, first point number 1, introduction to leverages. I have taken 2 examples: formula, detailed analysis, additional analysis, alternative formula, derivation to the formula, understanding business risk in a different perspective, summary of risk. Then we have to do the problems. Problem solving, you know, How beautifully we will do in class. It just take very less time. Concept understanding in financial management is difficult. Once you understand and take the knack over the concept clearly, just like that you can complete the concept. Clear? So let's start. So before we start with the chapter leverages, first it is imperative for everyone to first understand what is the meaning of the term leverage. So simple language, like if you want to define the term leverage, it says as under. See here. So leverages in general means advantage. Leverage means an advantage. Business leverage or operating leverage means operating advantage. Finance leverage means financial advantage. So that advantage, what you get without putting any additional effort, is called as leverage. Okay, is called as a leverage. Sorry. Okay, I will explain in 2-3 ways. You can understand in any of the following ways or all of the ways. First, there is a gear cycle. Gear cycle will be there. Na? Cycle with gears. Okay, there is a gear cycle. What is the working of a gear cycle? How they work? I will explain. I am not going into the mechanics of gear cycle. Basics to understand gear cycle with finance. Okay. A person is pedaling a cycle. Okay. That person is riding a bicycle. Gear bicycle. Pedaling it, he is moving on. He is now at a speed of 15 kmph. Means 15 kilometers per hour speed. Moderately in a cycle, that is decent. Okay, you can also go up to maximum 25 30 max. Beyond that is not suggested. So 30-35 kilometer speed he is going, or 15-20 kilometers he is going. Sorry, he is moving, he is riding at 15 kilometers per hour, moderately a slow speed. It's a gear cycle. After taking a speed of accelerating to around 15 to 18 kmph, immediately he shifted the gear. It started moving at 25. Again he shifted the gear. It started to go to 30. Again he shifted the third gear. It went up to 35-40. That's all. This is what the story. Story completed. From this, what you understood? Did I put any additional effort to increase the speed, or I am pedaling at the same speed but the gears are helping me? Gears are helping me. That means without putting any additional effort, these gears are helping me. That gear in mechanics is also called as lever. Is called as a lever. Lever is a device which will help in science, in mechanical engineering. Lever is a word which is very popularly found, which will put advantage to the mechanics of anything you manufacture without putting any additional effort. Lever will help you. In a gear cycle, you are riding at 15 kmph. You shifted the gear. Without you putting any additional effort, automatically the cycle picks the speed than what you really has done. You put effort only up to 15 kmph, but when you shift the gear is making the cycle to move at 25, 28, 30, 35, even up to 40. Means who is helping you? The lever is helping you to give that additional advantage without putting any additional effort. Hope everyone understood what I said now. This is the first way of understanding. This is a lever. Lever is a something which gives an advantage, actually an added advantage, without putting any additional effort accordingly. Okay, one way. Second thing. Second example, this is the first example, that's called as a lever. Number 2, see here. Okay, Okay, now listen carefully. Here there is 70 kgs rice bags, 4 5 rice bags, okay, amounting to 70 kgs. Therefore, it was a steep towards the left side, raised towards the right side. Okay. Now, I said a person is catching here. Okay, a person is holding it. Okay, holding it on the other side, and rice bags are there on other side. I want these rice bags to come up. What you have to do? Lot of effort you have to put in order to bring this down. If this comes down, automatically it will go up. Okay. Now, to take that advantage, I used a lever. I kept like this. Okay. Immediately a base is created here. Okay. Appropriate size, appropriate place in the middle, I kept it. Immediately when I pull it down, automatically it rises like a seesaw. Originally, a 50 kgs fellow cannot lift 80 kgs fellow. But in seesaw it is possible. Seesaw will be then in parks. In seesaw it is possible. Why? Because of lever attached here. Without putting any additional effort, that lever will help you to lift the load. Okay? This is second way of understanding a lever. From this, what you have to understand? You have to understand that lever is something which will put an advantage to you without putting any additional effort accordingly and appropriately. Clear, everyone? So, this is the point. So, first example from mechanics I have taken. Second example, a basic lifestyle example I have taken. Third one is a finance example, which we have to understand through the numbers only, not like this. Okay. So, first two things you understood now. Now, I have a question. Sir, always you are telling that lever will give an advantage in some circumstances. Why, sir? I not always. Why only in certain circumstances? Okay. Now, listen, I will give you one example. Okay. I will give you what? One example. Okay. See here. 70 kgs load empty. Okay. Now, answer my question clearly. There is a lever or not? Yes. Okay. I kept exactly in the middle, like previously. This is the size of a lever. Is it sufficient? Is it sufficient? Imagine 70 kgs load is there on the left side. You are sitting on the right side. Small lever, small stone like lever is there. Okay. If you push it down, that rice bag will move up only 1 inch. Is it useful? No. That means appropriate size of lever must be there. Okay. Second example. Okay. Appropriate size. Appropriate size is there. I kept here. I kept lever there. Now answer my question clearly. Now it is impossible to lift this through this pulley, because if you try to push now, you can't go beyond, you can't go below, because there is a lever attached to that. Here size is perfect, but the placement is wrong. Here placement is correct, the size is wrong. That means understanding how much lever should be there, at what appropriate place, at how much quantity is the important thing that you need to understand. Yes, understanding this lever will be done in the chapter called as leverages. Where to put that lever, to what extent we need to put, what is the volume of lever it should be, will be discussed in the next coming chapter called as capital structure theories. That's how these two chapters are interlinked together. Okay. Now I will give example also for the first one. I started a gear cycle. Okay. I removed the stand. I sat. I shifted the gear. Tell me, will cycle move or will not move? Arey, first you need to put some effort. After that, this particular lever will help you to gain the speed without putting in additional effort. Without even putting an effort, don't change the gear. One gear is there, useful or no use. 55 gears are there, useful or no use. Gear is there in the front wheel, useful or no use. Gear should be there on the back wheel, and gear should be optimally placed at 3 or 4 gears maximum. And after picking up certain speed, it should be what is the speed after which we can use gear 1, 2, 3, 4, and where it should be placed, how many gears should be placed is a science and mechanics. Exactly. In finance, how much operating leverage you need to put, how much business leverage you need to put, how much financial leverage you need to put, at what quantity you need to put, at what level you need to put, to what extent you need to put, all this is a science. The science of how much lever should be there is what we are going to discuss in next coming two chapters called as leverages and capital structure theories. Hope everyone understood the logic behind what I discussed now. Clear? So this is the basic intro to understand this chapter called as leverages. So everyone, I am putting this video, whatever I am recording now, because so many students are asking, sir, we couldn't understand leverages chapter. So therefore I am putting this on YouTube. This is a video recorded for ongoing FM batch. But because of so many requests I received, I am putting it on the YouTube directly. Whether you understood up to here, the 20th minute or 21st minute, whatever I uploaded now, okay, in this, if you have any doubts, you can ask in the comment section. If you understood also, please put a message. It motivates us to do something new and something good for you, such that I can understand faster whether you understood the concepts clearly or not. Clear? So let's go to the next part. So first one, introduction to leverages. Sir, in leverages chapter, one should understand 6 important things, rather 5 important things at least. One is income statement. What is the first one? Income statement. So why everything I will discuss, you know about me very clearly. I didn't leave even a single detail. I have to cover everything means I will cover everything. So please listen first. Income statement. Income statement is other way of presenting the P&L. So as I said, income statement is nothing but other way of presenting the P&L. P&L, all items will come like salaries, everything. But here we don't show anything like that. We will talk all of them in one place called as a variable and fixed cost. That means we bifurcate all the costs into 2 parts. Number 1, variable cost. Number 2, fixed cost. Okay, sir. Okay, now let us see the cost structure and the details of a particular company. Listen, leverages chapter don't just require finance knowledge. You have to measure the knowledge of finance and costing. Both are required. That's why this chapter people are by hearting the formula and going to exam. They are asking different questions. You need to have the knowledge of marginal costing, and we need to have a knowledge, good grip over finance. Okay, now I will play the role of 2 faculties now in this chapter. Number 1 is FM, number 2 is a costing. More about costing I will discuss, like break even point sales, margin of safety, PV ratio, okay, PV ratio, contribution, all these things I am going to discuss in detail. I am not telling overall, as if I am a costing faculty I will behave today. Okay, so you should understand that today Koushik Mukhesh is not a FM faculty, FM and costing faculty both put together. Okay, sir. Okay, now listen. If tax come, I will become tax faculty. Anyway, I'll teach tax, na? Tax, finance, law, all subjects, sarvantaryami, multi-talented. So see here. First thing, let us first understand the cost structure. Variable cost rupees 6 per unit. Fixed cost rupees 2 lakh. Variable cost will be always expressed in per unit. Fixed cost will be always said in amount. Volume 1 lakh units. Okay, selling price per unit rupees 10. Capital employed is 10 lakhs, in which 10% is the debt capital and 6 lakh will be 4 lakh is the debt capital at 10% interest. 6 lakh rupees is the equity divided as 60,000 equity shares of rupees 10 each. Okay, first observe the income statement, observe the information that is given. Just a half a minute, please observe the information. Okay, so let's continue. Now, variable cost 6 per unit, fixed cost 2 lakh, volume is 1 lakh units, selling price per unit rupees 10, capital employed is 10 lakh. See the income statement now. Sales 10 lakh, variable cost 6 lakh, contribution 4 lakh, fixed cost 2 lakh, EBIT 2 lakh. First let us understand up to there. Sales is 10 lakh. How sales have come? Because how many units are there totally? Volume is 1 lakh. 1 lakh into how much is the selling price per unit? 10. So 1 lakh units sold at 10 rupees, 10 lakh. Variable cost 6 per unit. Number of units increases, variable cost also will increase. That's why we call it variable cost. It vary with the sales units. Okay. Volume is how much? 1 lakh. If it is 2 lakh, variable cost also will increase. Okay. That's why it's called as a variable cost. So sales minus variable cost. Okay. Sales how much? 10 lakh. Variable cost is how much? 6 lakh. Contribution is 4 lakh. Why this is called as a contribution? Do anyone know? I will give answer. Okay. You think of a situation why this amount is called as a contribution. Okay, we will do one thing. I will first ask you one question. This is not a live interactive session. I will do one thing. I will ask you a question. Really, do you know the answer to the word why it is called as a contribution? Why this is called as contribution? Do you really know why it is called as contribution? Because you might have completed costing already. Okay, then you should tell me why this amount is called as a contribution. Why that name contribution has come? You think of yourself. I will give answer for that. Is your answer matching with the valid answer what I give or not? Please comment in the comment box. Okay, such that you can understand. Okay, whether really what is the real meaning of the term contribution. Okay, let's come back. Sales 1 lakh units at 10 rupees to 10 lakh. Variable cost 6 into 1 lakh 6 lakh. Contribution 4 lakh. Fixed cost fixed anyway 2 lakh. EBIT 2 lakh. EBIT is also called as operating profit. What it is called as everyone? Operating profit. Okay, now from this you need to reduce the interest cost. Okay, 10% debt 4 lakh. 4 lakh into 10% 40,000. Next, EBT. What is the next one? EBT. Interest also reduced na EBT 1 lakh 60. On that tax for 30% we paid 48,000. EAT 1 lakh 12,000. Number of shares is 60,000. 1 lakh 12,000 divided by 60,000 will give you 1.867. So this light or pink color ribbons are there na? Sales, EBIT, EPS. We are now going to analyze these three. Linking of sales to EBIT, linking of EBIT with EPS, thereby linking sales with EPS, we are going to analyze in three topics called as operating leverage, financial leverage and combined leverage. Clear everyone? So therefore first try to understand everyone. I am not going to do anything great. Just I presented the information given in the form of a income statement. Everyone in the class, you are listening to the YouTube lecture, nothing will happen. Repeat the answer along with me. Tell me what is the format of income statement. Sales minus variable cost, contribution, fixed cost, EBIT, interest, EBT, tax, EAT divided by number of shares, EPS. Everyone repeat once again. First one, sales minus variable cost will give you contribution, minus fixed cost will give you operating profit EBIT, minus interest will give you EBT, minus tax it will give you EAT divided by number of shares will give you EPS. Hope everyone understood the income statement format. Okay. Now everyone in the class copy down the income statement. Completed copying? Next. First one. So this is the income statement that we have extracted from the information that is given. Sir, why we are analyzing this income statement all of a sudden? To understand leverage. So let us understand this. See here, first, even before we go into any calculations part, first I will give you 6 formulae. How many? 6 formulae. What are the 6 formulae? These all 6 will be discussing about various formulae for calculating various kinds of leverages. Okay? First, there are 3 kinds of leverages. One is operating leverage, second one is a financial leverage, third one is a combined leverage. What is an operating leverage, finance leverage, combined? Reasoning we will discuss once after you write this. First, everyone copy down in your notes very clearly leverage, operating leverage and formula. Two types of formula will be there. One is contribution by EBIT, second one is change in EBIT by change in sales. Second one is type number, financial leverage type 1, EBIT by EBT. EBT can also be written as EBIT minus interest. Type 2 will be percentage change in EPS to the percentage change in EBIT. Type 1 to the combined leverage, contribution by EBIT minus interest. Okay, contribution divided by EBIT minus interest means contribution by EBT. So type 2, percentage change in EPS to the percentage change in sales. Logic, reasoning, idea behind this, model, modus operandi, every single point we will discuss. You know well about me. First write down the formula as it is. Copy down. Copy down the formula. I will give enough time for you to copy. Please copy down the notes. Once you copy the notes, now with numbers we will prove these. Okay. Completed writing the formulae. So there are totally three types of leverages. One is called as an operating leverage. Second one is called as a financial leverage. Third one is called as a combined leverage. Combined leverage. Okay, now see here how to express this type 1 and type 2. Type 1 in all the three cases. In operating case, finance and combined case, type 1 will be expressed in times, number of times. Okay. So obviously, first observe the income statement. Sir, I'm not joking. I'm telling very seriously. This particular entire chapter revolves around income statement. If you could not interpret income statement properly, you will suffer in ratio analysis as well. Because ratio analysis chapter also is dependent on interpretation of income statement. So please ensure that you are listening to this chapter carefully. Okay, though this is a very small chapter in your syllabus, it will be very, very important base for all the other chapters. So please listen. So sales 10 lakh, variable cost 6 lakh, contribution 4 lakh. Okay, fixed cost 2 lakh, EBIT 2 lakh, interest 40,000, EBT 1 lakh 60, tax 48,000, EAT 1 lakh 12,000, EPS is 1.867. These are contents of an income statement. Okay, now listen carefully. Contribution, why it is called as a contribution, I asked you now. That answer I will give at an appropriate place. As of now, listen. Contribution is a inflow. How you can tell it is an inflow? Sale 10 lakh, variable cost 6 lakh, excess over the variable cost is 4 lakh. Okay. So simply to tell, contribution is something which is always having a positive note. Okay, 4 lakh. Fixed cost 2 lakh negative. EBIT is 2 lakh. Okay, now understand clearly. I can get EBIT only if there is a contribution. Only if there is what's a contribution. EBIT is a operating profit. Is what profit? Operating profit. That means profit generated from the operations. Sales is an operation. Okay, operating, factory operates, sales generated. It's called as operating revenue. These are operating costs. After removing variable and fixed operating costs, whatever the profit you get is because of contribution. Okay, so if contribution is negative, there is no question of positive EBIT. So profit comes if sales are more than the total cost. Sales are more than what's a total cost. Okay. So simply to tell, I can express this way. 4 lakh is the contribution. From that 4 lakh, 2 lakh is deducted. 2 lakh balance EBIT came. 2 lakhs balance EBIT came. So how much is the EBIT balance? So 2 lakhs is the EBIT balance. Minus interest, like that we reduced everything and we calculated EPS. Now my question, listen carefully. If there is contribution, chance is there that there will be EBIT. Why chance? Fixed cost is also there. So if fixed cost is, say for example it is 1 lakh, then my profit is 50,000, 3 lakh 50. If it is 4 lakh, 0. So if the fixed cost is 5 lakh minus 1 lakh, so therefore I can't guarantee always how much is the contribution times to EBIT. To calculate, that means this operating profit is because of contribution. Higher the contribution, higher will be the EBIT. Therefore, the lever here is the contribution. What is the lever? Contribution is the lever here. So it is acting as a lever. So therefore, calculate the operating leverage. Always remember, operating means your mind should not come to interest, EBT, tax, EAT. Operating is always confined to the first 5. Okay, first 5. Financial, second 5. Combined, total income statement. First 5 elements we are going to analyze. Okay, first 5 elements. Okay, now first 5 elements: sales, variable cost, contribution, fixed cost, EBIT. So now operating profit will come because of having sales because of having variable cost, because of having contribution, contribution only will be the element which will give rise to EBIT. So therefore, comparison between contribution and EBIT is what we call as operating leverage. Here the lever is contribution. So here the lever is what's a contribution. So therefore sales minus variable cost contribution. Okay, contribution by EBIT means EBIT is 2 lakhs. Contribution is 4 lakh. Means my contribution is 2 times the EBIT. Like that they will express. How much lever effect is there? 2 times lever. How much advantage it given? 2 times advantage it has given. Okay. So therefore EBIT is 2 lakh. Contribution is 4 lakh. Means how many times is the contribution to EBIT? 2 times. That's called as operating leverage. This is type 1. Okay. Sir, what is the type? Type 2 I will discuss separately. Okay. Financial leverage. Okay. Now, see here. Financial leverage is the second thing. Financial leverage starts from below this. Okay. Starts from EBIT. End with the EPS. Okay. Now, from this EBIT, I will be first paying interest. I will get EBT. On that, government will collect the tax. Later, EAT divided by number of shares will give EPS. So, observation is required. Tax is something which is not in my hand. Okay. So, therefore, don't consider this. Consider this means don't ignore. I'm not telling ignore totally. As of now, for understanding, ignore it. Okay. So, the element EAT is coming after EBT. EBT after what will come? EAT. EAT will come first, EBT will come first, EBT will come first. EBT reduced by what? Tax, which is not in my hand. In my company hand, it will not be. Tax I can decide. I will pay 10%, I will pay 15%, I will pay 5%. Then everyone will tell I will pay 1% tax. Tax is something which is not in our hand. Therefore, what is in your hand, analyze on that basis. EBIT after what is in your hand. EBIT is in my hand. If I perform well, sales increases. Variable cost increase. Contribution increase. Same fixed cost will be there. EBIT will increase. It is in your hand. Interest, it depends on how you borrow. It is in your hand. EBT will be in your hand because EBT comes after payment of interest. Tax is something which is not in your hand. It is in the hands of government. So therefore, let us not compare EAT. Okay, EAT we will compare, but to understand leverage, ignore that for a temporary period. Okay, so the comparison between EBT and EBIT is called as a financial leverage because a financing item called as interest comes there. Tax is not a finance, tax is an obligation. So therefore, financial leverage links EBIT with EBT. Therefore, they will write EBIT divided by EBIT minus interest. EBIT minus interest means indirectly what? EBT. So, hope everyone understood. Now, without even remembering or by hearting formula, you can now answer by seeing the income statement. Okay, tell me now. What is the type 1 formula for operating leverage? First operating leverage, when I ask now, first 5 or next 5 first 5. Tell me what is the first 5? Sales, variable cost, contribution, fixed cost, EBIT. Okay, first operating leverage I said. Leverage is an advantage. Advantage means a profit. So EBIT. Operating profits advantage. Okay, now profit will come because there is a sales, because there is a contribution, because there is a contribution, because there is what's a contribution. So therefore, contribution divided by EBIT is operating leverage. Financial leverage, EBIT by EBT. Why that formula came? Logic is very simple. In order to get EAT, okay, I should have EBT. Okay, EBT after EAT will come. How? After deducting tax. Tax is a variable cost, a fixed cost, a variable. It varies with what? It varies with your profit. Okay. So it is levied by the company, levied by government. It is in our hands, not in our hands, not in our hands. Then why you are considering that in decision making? Therefore, compare EBIT with EBT. Compare EBIT with EBT. And shall I tell you one important point? Contribution is there. Contribution is a positive number. EBIT will be positive or negative. It can be positive, it can also be negative, because it depends on fixed cost. Therefore, comparison should be between EBIT and contribution. You need not compare with EAT with EBIT or EAT with EBT, because this is a variable cost which vary with EBT. For example, my EBT is not 1 lakh 60, it is 2 lakh, then that becomes 60,000. If EBT is positive, listen to my words clearly, if EBT is positive, it is 100% sure that EAT will be positive. But if contribution is positive, you can't give a guarantee that EBIT is positive. Okay, because there is a fixed cost involved between. Okay, so I will explain this way. Contribution positive, is there a guarantee that EBIT will be positive? No. Likewise, EBIT is positive, is there a guarantee that EBT will be positive? No, because another fixed cost called as interest is there. Okay, EBT is positive, is there a guarantee that EAT is positive? Yes, there is a guarantee, because if EBT is a positive income, on that only I will collect a variable tax. 1 rupee only you got a profit, 30 paisa you pay, 70 paisa profit will be there. So if you can observe clearly, here one fixed cost is involved, here one fixed cost is involved. Before this fixed cost, contribution is there. After this fixed cost, EBIT is there. We compared these two. Okay, now next, this is a income, there is a fixed cost, there is a total amount. Comparison between these two will become another leverage. So therefore, try to understand clearly, sir. This is nothing but operating leverage and financial leverage is nothing but analysis of fixed costs. Analysis of fixed costs. Two types of fixed cost: operating fixed cost, financing fixed cost. Operating fixed cost means electricity cost, rent to a factory, all these are the fixed costs. Okay, rent to factory, salary to the workmen, okay, municipal charges, certain basic duties which are constant every month, those all will come under fixed cost, operating fixed cost. Interest on debentures is a financial fixed cost. Okay, so comparison will be between EBIT and contribution, EBIT and EBT. Contribution after one fixed element, EBIT after one fixed element. So those two only we will analyze. We don't analyze between EBT and tax, EAT, because there is a variable item. If this is positive, automatically this will become positive. Hope you can understand the context and point. So this is another very important point that everyone has to understand. Okay. So first, I think you have copied this now. First, let us calculate this. Leverage formula and calculation. Operating leverage, contribution by EBIT. How much is the contribution? 4 lakh. 4 lakh by 2 lakh is 2 times. Next, financial leverage, EBIT by EBT. 2 lakh by 1 lakh 60. 2 lakh by 1 lakh 60 is 1.25 times. Next, combined leverage, just it's a multiplication of both of them. Simply to tell, contribution by EBIT into EBIT by EBT. EBIT cancel. Contribution by EBT is the answer. Contribution by EBT. EBT can also be written as EBIT minus interest. Contribution 4 lakh divided by 1 lakh 60,000. 2.5 times. Okay. Please copy down the answer. Completed solving. Now up to here, if you observe, we haven't done anything great. First we understood, so let's compile everything whatever we discussed till now. If you have to compile everything, just first we understood the income statement, understood that there are 10 items in income statement. From beginning of sales ending with EPS, 10 items will be there. In that, some variable will be there, some fixed will be there. Okay, so you do one thing, for understanding sake, in your notes you point down, this is variable, fixed, variable, fixed, variable, 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 and variable. You write down like this. Okay, I am erasing from my notes. Hopefully everyone has copied, and nothing great here. Interest is one such item. Okay, interest is one such item. After interest, fixed cost is one another item. Okay, those two are fixed, but those two are the most interesting discussions that we are going to make today in this particular leverages area. Okay, now see there, leverages calculation also done. Leverage calculation was actually done with the numbers as well. Done. We also done this. Next, detailed analysis. Here we are going to see percentage changes. Okay, that's what the second type formula. Change in EBIT, percentage change in EBIT to the percentage change in sales. Type 2 in financial leverage, percentage change in EPS to the percentage change in EBIT. Type 2 in the third case, percentage change in EPS by percentage change in sales. Sir, what does these mean? I will explain with an example. This example will be a game changer for you to understand. I have given clear notes with regard to this. Everyone copy the notes without fail. Okay, don't copy during the discussion. My curse will be with you always. If you write at the time of discussion, I give enough time. At that time you bite your nails. At that time you write down. Discussion when going on, observe the numbers properly. Not that easy. Institute booklet, they didn't even explain any one of the point we are discussing now. Directly they have given some summary information, 15-20 formula they have given. Analyze it directly without making the student to understand the content. That's why you are taking the coaching, so please listen carefully. So let's make a detailed analysis of income statement. Let us consider an income statement with base and 10% increased sales information as under. Base means this existing information, and 10% increased information. Okay, everyone concentrate, take calculators. Nothing is required. Take calculator and get ready. First point, sales. Existing sales 10 lakhs. Existing sales 10 lakhs means 10 lakhs is the sales amount that we have today. Okay, variable cost 6 lakh. Everything is information already we had up to here. 1 year completed. There is a 10% increase in sales. Okay, 10% increase. What is the selling price today? 10 rupee. 10% increase means 10 into 110% means 11 rupees. Means how much, sir? 11 rupee. How many units? What is the volume? 1 lakh into 11 rupees. How much? 11 lakh. Like this, you should not think. When I tell 10% increase in sales, it is not the increase in the selling price, it is the increase in the volume. It is what? Increase in the volume. I am selling 1 lakh units generally. Because of good market boom, I am not just selling 1 lakh, 1 lakh plus 10%, totally 1,10,000 units I sold at 10 rupees each, 11 lakhs. When I tell 10% increase, 10% increase is on the sales volume, not on the selling price per unit. Hope everyone understood the point. So how much is the increase? 10% increase is there. Very good. Observation, don't write. I said really my curse will be there on you if you really write down during the discussion part. I mean it to say. So please listen carefully. After that I give enough time here. You copy down at that time. So listen. Minus variable cost. 6 lakh. Okay. 6 lakh. Whenever I say variable, number of units changes, na, cost also will change. Okay. Actually, I manufactured how many units in the first year? 1 lakh. Now I am manufacturing 1,10,000. So 1,10,000 into 6 rupee, 6,60,000. Okay. Next. Contribution 4 lakh became 4,40,000. Became 4,40,000. Okay. Now listen carefully. How much is the change in sales? 10%. How much is the change in variable cost? 10%. How much is the change in contribution? 10%. Simply from this, what you have to understand, percentage change in sales will be same as percentage change in contribution. Hope you can understand what I said. So from this, what is the moral of the story? If sales raises by 10%, contribution cannot raise by 15, contribution cannot raise by 5, 6. Exactly what is the rate of change in the sales, the rate of change in the contribution will also be equal. Okay. So if you take, say for example, take another number, 10 lakhs now, you take 20% increase. 10 lakhs plus 20%. How much? 12 lakh. Okay. Variable cost will become 6 lakh plus 20%. 7 lakh 20. So minus 12 lakh, 4 lakh 80. 4 lakh became 4 lakh 80 na. So 4,80,000 minus 4 lakh, whole divided by 4 lakh into 100, 20% came. Means if sales increases by certain percentage, contribution will also change by the same percentage. Am I clear, everyone? Okay. Now take the fixed cost. Take the fixed cost. Okay. You remove the fixed cost. Now we got EBIT. Tell me, EBIT existing how much? 2 lakh. It became how much? 2 lakh 40. Take calculator. 2,40,000 minus 2 lakh whole divided by 2 lakh into 100. How much? 20%. Now answer my question. Sales have increased by how much? Sales increased by 1 lakh. Sales increased by 1 lakh. But EBIT has increased by 1 lakh. Sales increased by 1 lakh. So percentage is how much? 10%. Sales changed by 10%. Because of change in the sales by 10%, EBIT has raised by 10%. EBIT raised by 20%. 20%. How that has occurred here? Why the magic has occurred? That's because of fixed cost. Though my sales units have increased, I will pay the same fixed cost. Therefore, this fixed cost is now acting as a lever. Okay. Sales increased by how much? Sales increased by how much? 1 lakh units. Means percentage la 10% increase. If I increase sales by 10%, EBIT also should raise by same 10%. But EBIT raised by 20%. EBIT raised by 20%. Actually, if it is 10%, 2 lakh plus 10% should become 2,20,000. But it has become 2,40,000. Because of what? Fixed cost in the cost structure. Fixed cost inside what's a cost structure? Means what you have to understand, whenever there is a fixed cost element, it will always act as a lever. That lever can sometimes become advantageous, some certain times that lever can become disadvantageous. I will explain in a different way. See here. Instead of raising in sales, sales have dropped by 10%. Means 10 lakh minus 10% has become 10 lakh minus 10%. How much? 90,000. Variable cost will become how much? 6 lakh, and here it will become 5,40,000 only. So 6 lakh minus 10%, 5,40,000. Okay. So 9 lakh minus 5 lakh 40,000, 3 lakh 60,000, 3 lakh 60,000 minus 2 lakh, it becomes 1 lakh 60,000, 1 lakh 60,000. So 1 lakh 60,000 minus 2 lakh 40,000 whole divided by 2 lakh 40,000 into 100, 33.33 negative means 10% fall in sales has led to negative change of EBIT by 33%. Why? Because of fixed cost. So my question is, fixed cost is good or bad? Is it good or is it bad? It is both. Correct involvement of fixed cost will act as a positive lever. Inappropriate and not required, but still you are having fixed cost, it will destroy your very EBIT. Okay, so the lesson, moral of the story is, okay, change in sales will lead to change in EBIT, yeah? Will lead to a different change in EBIT, yeah? Different change. That depends on what? The fixed cost element. So I will ask you a question, everyone should answer now. Okay, listen carefully. Sales changes. Variable cost will change by different percentages, same. Contribution will change by different, same. Why same in all the three cases? Because in between sales and contribution there is a variable amount. Sales is variable, contribution is variable. In between also there is a variable. It changes according to the sales units. So therefore, percentage change of sales, percentage change in variable cost, percentage change in contribution, all the three will necessarily be same always. Listening? Next. But change in EBIT need not be same as a change in sales, because EBIT is influenced not by variable cost, it is after deducting a fixed cost. So EBIT need not change with the same rate of change as the sales. So therefore, listen carefully. First formula we analyzed contribution and EBIT. Okay, now we are going to analyze source and destination. What is that? Source and destination. I will ask you one question. Contribution changes by itself, contribution changes because of change in sales. Sir, what is the contribution at the beginning? 4 lakh. What is the contribution at the next year? 440. It became 440 by itself. It became 4 lakh 40 because of sales change. Sales change. Therefore, this is a source. This is a destination. So, therefore, when you talk about percentages calculation of leverages, percentage change in EBIT by percentage change in sales. Everyone repeat. Percentage change in EBIT divided by percentage change in sales. Percentage change in EBIT by percentage change in sales. Sir, why sir? Why not percentage change in sales by percentage change in EBIT? A question may arise. Listen carefully. Percentage change in, whenever I write delta means a change. Percentage change in EBIT by a percentage change in sales. Okay, listen carefully now. My question is, always denominator should have influencer, numerator should have influenced. Denominator will always be on x-axis, numerator will always be on a y-axis. Sales will impact EBIT, EBIT won't impact sales. Change in EBIT do not lead to change in sales. Change in sales will lead to the change in EBIT. Therefore, influencer should be always on a denominator. Influenced should be always on a numerator. Therefore, what changes because of what? EBIT changes because of change in sales. Sales don't change because of change in EBIT. So therefore, first formula is number of times. Second formula is influencer and influenced stage. Okay. So to get EBIT, I need to have contribution. So telling that in terms of times is the first type of formula, easy formula. But a real interpretation is change in EBIT because of change in sales. How much percentage is there? is what we are going to see here. This percentage of 20 will be same in all cases or different? Different. It differs because of what? Because of fixed cost. Because of what cost? Fixed cost. Okay. So now listen carefully to the point. Change in EBIT, percentage change in EBIT will be the percentage change in sales, will not be percentage change in sales. I will ask a question now, answer properly. Percentage change in EBIT is equal to percentage change in sales, not equal to percentage change in sales. It is equal to percentage change in sales if fixed cost is 0. Did you understand now? Percentage change in EBIT and percentage change in sales will be same if fixed cost is 0. If some amount of fixed cost is there, always remember percentage change in EBIT will not be same as percentage change in sales. Say for example, alternatively let us take fixed cost as 1 lakh. Fixed cost as what, sir? 1 lakh. Okay, take now 11 lakh, take calculator, 11 lakh minus 6,60,000 minus 1 lakh, 3,40,000. 2 lakh has become 3,40,000 now. Okay, 3,40,000 minus 2 lakh, 3,40,000 minus 2 lakh, whole divided by 2 lakh into 100. How much percent? 70% is my operating leverage. Bumper profit say. From this what you have to understand, whenever company is employing fixed cost into its cost structure, that fixed cost will give you greater advantage. But if you take that fixed cost as 5 lakh, if you take the fixed cost as how much, sir? 5 lakh, what will happen? 4,40,000, okay, minus a fixed cost of 5 lakh, negative EBIT has come, minus 60,000. So how to do this? How to do this minus 60,000? Previously it used to be 2 lakh. Now it happened to be minus 60,000. Means how much is the change? 2 lakh has become 0. 0 has become minus 60,000. Am I clear? So therefore 2,60,000 divided by 2 lakh into 100, 130% negative change is there. So therefore listen carefully. Fixed cost is not just hero. Sometimes it is also a villain. So how much fixed cost you should employ in the capital structure is the decision making of the concerned department in company. For that only you got costing departments in companies. Okay, so how much fixed cost we can have, how much variable cost we can deploy, everything. Clear everyone? So always listen, when the number of sales units increases, when the number of sales volume increases, automatically company having fixed cost will take great advantage, because with the raise in contribution, fixed cost don't raise. So therefore there is an advantage. Okay, now listen, in my company there is interest also. What do you mean by interest also? Interest is another financial fixed cost. I said to the debenture holders that I will pay 10% interest. Even if profit raise, I won't pay extra. Even if profit falls, I can't pay less. It's a fixed cost. So even if my EBIT is 2 lakh, I need to pay 40. Even if my EBIT is 2 lakh 40, I should pay 40. So therefore 2,40,000 minus 40,000 will give you 2 lakh. Okay. Previously, what is the EBT? EBT 1,60,000. Now it is how much? 2 lakh. So 2 lakh minus 1,60,000 whole divided by 1,60,000 into 100. The answer is not 20. Answer is 25. Means my profit percentage is further magnified. This magnification has become first because of fixed cost, next because of another fixed cost called as interest rates. Okay, so EBT further increase. Again, tax same percentage, EAT same percentage, number of shares anyway same, EPS will become 2.33. If you observe answer, EBT, tax, EAT, EPS percentage change will be same. Sales variable cost contribution is same. Like that, EBT, tax, EAT also same. Why? Because all those are variable again. Always changes in variability will be same. Fixed cost when involved, suddenly magnification will come. Clear everyone? So therefore try to understand clearly. Shareholders will look for, listen to my words. Shareholders will look for EBT, EAT, EPS, EPS. So change in EPS, even you take change in EBIT, change in EAT, change in EPS, all the percentages are anyway same. So change in EPS to the change in EBIT, okay, to the change in EBIT is called as a financial leverage. It's called as financial leverage because there will not be, listen to my words, there will not be EBT if there is no EBIT. If there is no EBIT, EBIT can't be there if there is no sales. No sales, no EBIT. No EBIT, no EBT. Means to get the EBT, the source is EBIT. To get EBIT, the source is sales. Therefore, percentage change in EBIT to the percentage change in sales, operating leverage, percentage change in EPS to the percentage change in EBIT is the financial leverage formula. That's the second one. Percentage change in EPS to the percentage change in EBIT. Source. Okay, source will be always on denominator, destination will be always on the numerator. So EPS changes because EBIT changes. EBIT changes because sales changes. Okay, this is another way of notating the same. Okay, so I have given clear notes. Operating leverage links sales and EBIT. An operating leverage of 2 times means when sales changes by 1%, EBIT changes by 2%. This operating leverage happens due to employment of fixed costs in the cost structure. The operating leverage has a high return generating capability when sales increases. Negativity is also there. At the same time, the drop in profit is steep, very sharp, very fast when sales decrease. This is called as operating risk or a business risk. Okay, to conclude, operating leverage can be defined as follows. It is a use of fixed cost to magnify the increase in sales on EBIT. The risk associated is called as a business risk or operating risk. Financial leverage links EBIT and EPS. A financial leverage of 1.25 times means when EBIT changes by 1%, EPS changes by 1.25%. Okay, financial leverage happens due to use of debt in the capital structure. Use of what's a debt in capital structure means fixed income security. It is called as a finance risk. So to conclude, financial leverage can be defined as use of debt in capital structure to magnify the effect of EBIT on EPS. Okay, next, combined leverage links sales and EPS. Combined leverage links sales and EPS. A combined leverage of 2.5 times when sales changes by 1%, EPS changes by 2.5%. This happens due to fixed cost in cost structure, debt in the capital structure respectively. This is called as a combined risk, multiplication of first two. Okay, so this is all I want to explain in the next stage. So please keep the heading, write the notes. Completed writing. So next one. So enough time taken in this regard. So let's go to the next one. Now additional analysis. So this additional analysis is required to understand certain costing concepts. Okay, to understand certain what concept? Costing related concept. What is a costing related concept? In costing you might have already done a chapter called as a marginal costing. What is a costing? Marginal costing. You might have already done that chapter, marginal costing. Okay, in that marginal costing, see there, PV ratio, income statement, PV ratio, BEP in units, BEP in rupees, margin of safety, profit, all these things will come. Okay, sir, why sir unnecessarily you are teaching about costing related concepts, though it is okay, but why you are unnecessarily teaching costing? I told hundreds of times and again I have been repeating the same. I am not a damn bloody fool to waste your time and waste my time as well, which is very valuable, and we have lot many works to do. My only agenda is, if I have to teach something, I will teach from its scratch till its end. That's the only intention. Okay, I'm not a damn bloody fool unnecessarily to explain things to you. Okay, see here. Operating leverage is there. Huh? Okay, first they explained formula, everything. After that, break even analysis given in your study material. BEP. Okay, that's one thing. I will explain clearly. Margin of safety, PV ratio. Okay, okay. They are asking questions on that in exam. This is a question which came in examination for 4 marks already. So therefore, I am not unnecessarily teaching anything, but what I will do is, I can tell you only one important thing in this connection. Okay, what I can tell you, what I can ensure is, I will explain the same costing you have already learned. Okay, in marginal costing you might have already learned all these things, but after listening to the lecture today, you will realize that I didn't listen anything. That I can give a guarantee to you. Okay, that guarantee I will give you definitely for sure. So many concepts what I learned, why I didn't learn in main core area called as costing, that assurance I will give you. So the level of understanding we do today will be times higher than a normal costing. Okay, let it be costing, let it be FM, let it be any subject. If I have 100% confidence that I can definitely do justice, then only I will take it. Okay, that's why all subjects in CA curriculum I can teach in the same way except auditing. That's why I don't touch it. Never from my mouth a concept will come from audit, because I am very poor at it. I don't have a clarity about what they try to say. Remaining all the subjects you take, okay, remaining all the subjects starting from the accountancy till the end of all the subjects except one subject called as audit, which is a villain in my life. So let us analyze the concept called as cost sheet in a clear way to understand. Okay, I asked you one question. Don't underestimate that I forgot about that question. Why this is called as a contribution? I asked you a question. Even till now I didn't give any answer for that. Now I am going to answer that. Okay, next. Now see, additional analysis we are going to make. I am taking a different example. Selling price per unit 10, variable cost per unit is 6, fixed cost is 10,000, sales is 6,000 units. Sales is how much units? 6,000 units. I am asking you 5 questions. Prepare income statement, calculate PV ratio, okay, BEP in units, BEP in rupees, and margin of safety, profit. Profit means EBIT. Okay, now listen carefully. Don't write anything because I have to make some alterations to this. So please listen carefully. Don't spoil your notes. First listen. Let me complete the entire discussion. If I tell that everything is completed, then you can copy down entire answers. Okay, listen first. Income statement. Sales 6,000 units into 10 rupees, 60,000. Variable cost 6,000 units into 6, 36,000. Contribution 6,000 units into 4, 24,000. Fixed cost is 10,000. profit is 14,000. Now I will ask you a question. I told you now, what you learnt in costing, the way in which you learn today, you will get out what I heard in costing. Okay, I promised you that. So listen first. Sales is 60,000. Okay, what are all the costs? 36,000 minus 10,000. How much is the answer? 14. Sir, here there are two costs. Variable cost 36,000. Variable, one second. Variable cost 36,000. Fixed cost 10,000. So what are the two costs? 36 plus 10,000. How much? 46,000. So 60,000 minus 46,000. How much is the answer? 14,000. I can directly present that way. Why we are bifurcating into variable and fixed cost is my question now. Hope you can understand. You can give a reply in the comments box when it is going live. So my question is, sales is there na? There are two costs, 36,000 to 10,000, total 46,000. Instead of bifurcating 60,000 minus 36,000 minus equal to 24,000 minus 10,000 profit, why to bifurcate between variable and fixed? What is the need? What is the need? Marginal costing is based on this premise. The foundation of marginal costing is understanding income statement. So tell me, why this bifurcation is required? Why this variable cost, fixed cost division is required? What is all going on? Tell me. If you don't know, at least listen now. When you listen, please put a comment that you learned something on this, such that I will get a clarity that you heard the concepts clearly. Sir, I will explain. Sales, 6,000 into 10, 60,000, variable cost 36,000, contribution 24,000, fixed cost is 10,000, profit is 14,000. Okay, now listen carefully to the point. How many units I sold? How many units I sold? 6,000 units I sold. If I sell 6,000 units, my profit is 14,000. If I sell 6,000 units, my profit is 14,000. Am I clear? Now I will ask you a question. I want a profit of 28,000. I repeat, I made a sale of 6,000 units. My profit is 14,000. I want a profit of 28,000, double the existing profit. Now how much sales I need to make? If you want double the profit, you need to make double the sale. So therefore the sale units must be 12,000. This is wrong. Yes. Take the answer now. 12,000 into 10, 1,20,000. Okay. 12,000 into 6, 72,000. So 1,20,000 minus 72,000, 48,000. 48,000 minus 10,000 means its answer is 38,000 here. I want only 28,000. That's the reason why bifurcation is made. Hope you can understand now. Why we make analysis as a differentiation between variable and fixed cost is for decision making. So decision making time la, how people will ask, they don't ask how much sale, they ask how much profit. I want a 28,000 profit. How many units I need to sell? You should not tell, okay, 6,000 to 14,000, 28,000 means 12,000. Then you become the biggest fool on this planet. Why this is not happening? Because the reason is fixed cost. Therefore, first we need to bifurcate into two parts. Bifurcate into how many parts are? Two parts. One is a fixed profit. Second one is a variable profit. Okay. Or one is profit which is proportionate to sale. Another thing is profit which is not proportionate to sale. I repeat. Costs are divided into two categories. Yes. Therefore, profits also should be divided into two categories. Category 1 is sale related profit, sale not related profit. Example, I sold 6,000 units. I got a contribution of 24,000. I want contribution of 48,000 means blindly you can tell make double. Now you can tell because this is variable, this is also variable, middle also is a variable thing. Therefore, whenever you want to double this, it requires the double of these two as well. So blindly you can tell. But profit and sales you can't tell because in middle there is no variable item. This is a fixed item which you don't change along with the sales. Therefore, percentage change in the profit need not be equal to percentage change in sale. That's why we have done the operating leverage. Hope everyone is having a clarity now. So therefore, Nana, you underestimate two things. Number one, Koushik Mukhesh. Number two, costing. So if you clearly observe the numbers in marginal costing, everything inside finance also you can understand. So listen carefully. Sales is 60,000, contribution is 24,000, profit is 14,000. If you can observe these numbers clearly, two things you can understand. There are two types of costs, there are two types of profits. That's why contribution is divided. Why? Contribution is called as a sale proportionate profit. Profit EBIT is called as sale disproportionate profit. This profit has nothing to do with, this profit don't have link with sale. Whatever may be the sale, this fixed cost is same. Therefore, this profit, whatever I am telling, is not in proportion with sales. It will change with sales, but not actually at the same amount. For example, if I double the sale, variable cost will be doubled. If these two are doubled, contribution is doubled, but fixed cost don't get doubled. Therefore, always decision making when you are taking, for decision making purposes, you have to bifurcate both of them. Bifurcate both of them means what? Both variable cost and fixed cost, such that profits also should be of two types: profit without fixed cost, profit with fixed cost, such that they will take a decision whether to employ fixed cost or not. Okay, so listen carefully. Volume is 6,000. Okay, this volume is linked to two things: cost, profit. Cost is variable and fixed, and last one is a profit. That's why marginal costing's another name is cost volume profit analysis. Volume is the hero with two heroines. Volume is the hero with the two heroines. Heroine number one is cost, heroine number two is profit. Okay, so this is the first thing that I have to explain. Second thing, PV ratio. What is the second thing, sir? PV ratio. What is PV ratio? PV ratio means percentage of contribution to the sales. You can express this in two ways. Per unit you can express, total also you can express. Take calculator. How much is the contribution? 4. How much is the sale price? 10. 4 divided by 10, 40. This 40 is called as sale proportionate profit. That's also called as a contribution. Sale proportionate profit also called as contribution. Okay. So this is called as 0.4. Okay. Contribution by sales. Contribution per unit divided by sale price per unit. Okay. So 40%. You can tell in that way. 0.4 also called as 40%. Next. If you want to tell in overall contribution by sales, 24,000 divided by 60,000. That is another way. Contribution by sales. That means you will express how much contribution, how much is the covering of contribution to that of the sales. You can understand. PV ratio of 40% means when sales is rupees 100, contribution is 40. It means when sales changes by rupees 100, contribution will also change by same percentage of 40. Am I clear? Every 100 change in sale, 40 rupees will change. That's why I call it 40%. For every 100 rupee change in sales, contribution will change by 40 rupees. Change in profit equal to change in contribution because fixed cost doesn't change. Change in profit is the change in contribution. Okay. Next. Break-even point or break-even sales. Break-even point or break-even sales. Okay. Now, this requires some clarity. Listen carefully. Break-even point. Break-even point. Okay. Now, listen carefully. I asked you a question. Why this is called as a contribution? I asked you one question or not? Why it is called as a contribution? Because it contributes. Sir, what is this answer, sir? Why it is called as contribution? Because it contributes, sir. Yes, what you heard is absolutely right. That's called as a contribution because it contributes. So the summary for entire discussion is, I want to know about the change in the profits. Okay, for a change in a sales. Then I can't tell directly unless I bifurcate variable costs and fixed costs. So now we completed income statement analysis, PV ratio analysis. Now let us come to break even point. I already started now. Let me continue this. Break even point can be understood in two ways. Number one, break even units, break even amount. You can express in either of the ways. What is break even? Break even is a situation where, okay, you don't have any profit, any loss. Means profit should be equal to 0. Profit should be equal to 0. When profit will be equal to 0, say for example, I will make a reverse calculation to show you. Profit should be 0. Let's say there is a X amount of fixed cost. Okay, X amount of fixed cost. Okay, there is a Y amount of contribution. Y minus X should be 0. Okay, or I can tell 0 plus X equal to Y. Y minus X equal to 0. Y equal to 0 plus X ka. So therefore 0 plus X equal to Y. Therefore simply to tell 0 plus something will be the same number. So X should be equal to Y. Then only it's called as a break even. So in a simple sense, break even point is such a point where the contribution will be equal to fixed cost. Over. Okay, is a situation where the contribution will be equal to fixed cost. Contribution will be equal to what's a fixed cost. Okay, now listen here. This is one way of understanding, not the only way. This is one way. So therefore, what I said there. So it is something which can be understood as a situation where fixed cost will be equal to contribution. Contribution will be equal to fixed cost. Then I will call it as a BEP. Okay, now tell me, contribution should be equal to fixed cost, not units, amount. Contribution means what? Sales minus variable cost equal to contribution. So contribution per unit into number of units can be written as fixed cost or not? Yes, can be written as fixed cost. Okay, now listen carefully. Contribution equal to fixed cost is a BEP area. Okay, so now contribution I can write as contribution per unit into number of units equal to fixed cost. Okay, now number of units to break even will be equal to fixed cost by contribution per unit. Yes or no? Fixed cost by contribution per unit. So therefore fixed cost by contribution per unit is the second formula. How easy it is. Fixed cost by contribution per unit equal to BEP in units. This is another way of understanding the same. Okay, if you want me to derive this once again, I will do. See here. What is a BEP? BEP is a situation where contribution amount, okay, amount of contribution will be equal to fixed cost amount. So contribution minus fixed cost will be 0. Means both should be same. Contribution 10,000, fixed cost 10,000. What will happen? 0 will be the profit. That's called as a break even. Okay. Contribution in rupees can be divided into two parts. Contribution per unit into number of units equal to fixed cost. When both are equal, it's called as a break even. Therefore, these units will become break even units. So, break even number of units equal to fixed cost by contribution per unit. Like that, this formula has been derived. So, break even units are 2500. Okay, now, second part also over. So, next, tell me. Now, BEP units you came to know. How many units? 2500. I want break even not in units. I want break even in amount. How to do? break even units into sale price per unit will be giving me total break even sales value. Am I clear? So therefore, how much sale I need to do exactly to have break even? Units la 2500, but sale 2500 into 10 rupees is the sale price. So listen carefully. Listen carefully. So break even units, I want exactly the break even, not in terms of units, I want in terms of rupees. I want in terms of rupees. See here, break even units into sale price. Okay, now tell me, break even units, what is the formula? Break even units, just now we told, just now we have completed na. See here, fixed cost by contribution per unit, fixed cost by contribution per unit into sale price per unit, into sale price per unit. Okay, now listen carefully to the point. What is the PV ratio formula? PV ratio equal to contribution per unit divided by sale price per unit. Contribution per unit by sale price per unit. Okay, now here fixed cost into SP divided by CP, means sale price divided by contribution per unit. Okay, contribution by sale price is PV ratio. So fixed cost into PV ratio, this is PV ratio 1 by PV ratio, 1 by PV ratio. You didn't understand? I will repeat. You know about me very clearly. I will repeat 100 times also if you don't understand. So I will repeat one last time. From the beginning I will tell. So listen carefully to the discussion. Listen. Fixed cost or BEP in rupees is a situation where contribution should be equal to fixed cost. Okay, na? Contribution total rupees. Total contribution can be written as contribution per unit into number of units equal to fixed cost. Contribution equal to fixed cost is a normal break even. So these units also will become what? Break even number of units. So break even number of units equal to fixed cost divided by contribution per unit. This is okay. This is formula for break even point. Break even point in units. Okay, break even point in units. What is the formula for break even point in units? Fixed cost to total fixed cost by contribution per unit. So keep it aside. This is the formula 1. Okay, now I don't want break even in units, I want break even in rupees. How to tell? Break even point for per unit into break even of what? Break even amount of sales I need to make. I want break even sales value. So into sale price per unit, into sale price per unit will be equal to break even sales as a rupee amount. Clear everyone in the class? Clear everyone? So therefore, now how to write this? Break even units into break even units into sale price per unit equal to break even sales. Okay, now tell me, what is the formula for break even as a units? Fixed cost divided by contribution per unit into sale price per unit, into sale price per unit. I can also write this as fixed cost into sale price per unit by contribution per unit. Okay, already we came to know PV ratio equal to contribution per unit by sale price per unit. This is sale price per unit, sale SPU by CPU or CPU by SPU, SPU by CPU. PV ratio is CPU by SPU. This is SPU by CPU. So SPU by CPU can be written as 1 by PV ratio. So therefore FC into 1 by PV ratio. Therefore break even point in rupee terms equal to fixed cost by PV ratio. That's how this formula has come. Derivations also we completed. Okay. So the secret of success in understanding FM is about understanding other subjects properly. Okay, I always tell that how the derivation has come. This is how the derivation has come. Okay. So one small twist point before you close. We completed what now? Break even point. Break even point we understood from amount point of view, units point of view, both. Units point of view, if you go fixed cost by contribution per unit. Fixed cost by contribution per unit. How this concept came also I explained you. Okay. So next, in value also I explained everything clearly. Okay. So this is how you can understand. But one small point. Okay. See here. I am going to first income statement we understood. See there. See this. Sales minus variable cost gives contribution. Sales minus variable cost give what, sir? Contribution. Why it is called as a contribution? Because it contributes. It contributes to what? It contributes to the payment of fixed cost, because the fixed cost will be paid from this contribution. From that EBIT is there. From this EBIT we are paying interest. From this interest we got EBT. From this only for the government we are paying taxes. From this only we are distributing dividend to the shareholders. From this what you have to understand, if this amount is a zero amount, because sales automatically you will make. If cost is more than sales, contribution will become negative. Okay, so how the contribution is there, depending on that only remaining elements in the income statement will survive. Means if the contribution is zero, there is no question of positive EBIT. Then there will be no interest payment. Therefore, more and more negative EBT will come. Tax will not be there. No dividends. Means sales is the main source, but contribution is a sub-source. So therefore, contribution contributes to all the other items of income statement. That's why contribution came in third line. After third line, if anything is coming, that's because of contribution only. Contribution is something which contributes. Contributes to what? Contributes to EPS, contributes to EAT, contributes to EBT, contributes to EBIT, and also contributes to the payment of fixed cost, payment of interest, payment of taxes to the government. Therefore, it's called as a contribution. Second thing. See here. See the numbers. Fun in numbers you will understand now. How much is the contribution here? Number. Amount. How much is the contribution? 24,000. How much? 24,000. Okay. Now, contribution per unit is how much? Contribution per unit is how much? Contribution per unit is how much? What is the sale price per unit? 10. In that, how much is the cost? 6. How much is per unit contribution? 4. Okay, now how much is the fixed cost? 10,000. How much is the fixed cost, sir? 10,000. Okay, now I will ask you one question, answer. How much is the contribution, how much is the sale price? Take calculator. How much is the sale price per unit? 10 rupees. How much is the cost, variable cost per unit? 6 rupees. How much is the contribution per unit? 4 rupees. Okay, now, fixed cost will be on per unit, is a volume, is an amount, total amount, 10,000. So, we got 4 rupees contribution, but we have 1 unit. 1 unit we sold. Sale price is 10, variable cost is 6, contribution is 4. Okay, but we have how much fixed cost? 10,000 fixed cost we have. How many units I need to sell? Okay. With that contribution of 4 rupee, how many units I need to sell in order to pay the fixed cost of 10,000? How much is the contribution? 4 rupees is the contribution. How much is the fixed cost? 10,000 is the fixed cost. How many units I need to sell such that with this 4 rupees I can pay 10,000, 2,500 units. That's how the answer came as 2,500. Yes, sir. This is the correct way to understand. That's why you learn formula. I don't deny, but don't always flow in that formula. Understand the logic behind it, how the formula has come. Okay. So, how many units I need to sell in order to make this contribution to contribute to the fixed cost exactly. Now tell me, my contribution is 4 rupee per unit. How many units I need to manufacture? 2,500 to have a break even. Okay, 3000 if I manufacture, what will happen? 3000 into 4, 12,000, but I have only 10,000 fixed cost. My profit will become 2000. That 2000 is excess profit after paying fixed cost. That 2000 we call as margin of safety. That's the next discussion. What is the next concept? Margin of safety. Above the break even, if you make anything, it's a margin of sale. So simply, what is margin of safety? Total sales minus break even sales, either in units or in amount. If it is in units, 6,000 units minus 2,500 units, 3,500 units in our example. Okay, it's a margin of safety, 3,500. Or you can also calculate as a profit by contribution per unit. Profit by contribution. Exactly, if fixed cost is there, fixed cost 10,000 divided by 4, 2,500. After paying fixed cost, profit will come. Therefore, profit divided by contribution per unit will give you the margin of safety. Margin of safety in value you can understand in three ways. Total sales minus BEP sales, 35,000, or per unit margin of safety. Okay, margin of safety units 3,500 into sale price 35,000, or profit by PVR. What is profit by PVR? What is profit by PVR? Profit by PV ratio. Sir, why sir? Profit by PV ratio. See here. Margin of safety into sale price will give you the total margin of safety value. Yes. What is the margin of safety? Margin of safety can be written as, tell me, margin of safety can be written as break even means fixed cost by contribution. Margin of safety means profit by contribution. Profit by contribution into SP. Profit by contribution into SP. This can be written as profit into SP by CP. Profit into PV ratio means CP by SP. SP by CP will become 1 by PV. Therefore, profit by PV ratio is another formula for the margin of safety. Hope you can understand the concept, everyone in the class, right? Okay. Now, one very important observation, my dear friends. Very important observation is still there for us. What is this observation? What observation we need to make? Listen. What is, sir, why we are discussing about margin of safety, all these things, why we are discussing? There is a reason. Okay. What is the reason? See here. See the screen once, everyone in the class. The point why we are discussing about margin of safety, costing concepts, why we are discussing here, reason is there. Okay, see the reason. Margin of safety equal to profit divided by PV. Profit divided by PV. Or margin of safety in units if you want, profit divided by contribution per unit. Profit divided by contribution per unit. Okay. Profit divided by contribution. Profit divided by contribution. Contribution and profit will give you the margin of safety. Now my question is, profit means which profit? Earnings after tax profit, operating profit, sales minus variable cost, contribution minus fixed cost, profit means which profit? EBIT. That means I can write it as EBIT by contribution or not? Yes. Okay, EBIT by contribution. Now answer my question. Contribution by EBIT is called as a operating leverage. Yes or no? It's called as operating leverage. Therefore, MOS can be written as 1 by operating leverage, or simply to tell, operating leverage equal to 1 by margin of safety. 1 by margin of safety. Therefore, the formula is 1 by margin of safety. To understand this, we have done this much analysis. Am I clear? So, I made two types of analysis for this. The two types of analysis I will show you. See here. One big derivation, another one is a small derivation. Okay. So see there. First let us complete this concept. Margin of safety on a profit. Contribution is linked to sales. Okay. Fixed cost is linked to BES. And profit is linked to MOS. Because MOS means over the break even profit comes. Okay. That is the MOS. Sales are linked to contribution. Contribution will come because of sales. Okay. BES will come because fixed BES will come because it is paying the fixed cost. Profit comes when it's a margin of safety. When we produce and sell one unit, we incur variable cost and receive SP. What stays in hand is contribution. Contribution contributes towards a recovery of fixed cost and towards the profit. When you recover fixed cost, break even over. Beyond break even, if anything is there, that's profit. Okay. Calculation of profit you can do in various ways. I have shown you. Alternative formula. Derivation, I already wrote one derivation. This is alternative derivation. Total sales minus break even sales, okay, divided by total sales will be margin of safety as a percentage. Okay. So total sales, multiply both the sides with PVR. Total sales minus break even sales whole divided by total sales into PV ratio into PV ratio. PV ratio by PV ratio. PV ratio multiply by both the item. Sales into PVR minus break even sales into PVR divided by sales into PVR. Sales into PVR. Okay, sales into PVR. PVR means what? PVR means what? PV ratio means what? Profit volume ratio means what? It is nothing but CPU by sales. CPU by sales. So therefore, sales into PV ratio means what? Sales into contribution by sales. Sales cancel. What will be their contribution? That's how in the denominator, in the second stage, if you can observe here, contribution is there in numerator. Minus break even sales into PV ratio. Okay, will be called as a fixed cost. Why? Break even sales into PV ratio. PV ratio is nothing but contribution percentage. Okay, contribution percentage into break even sales means fixed cost will be paid exactly. Okay, fixed cost whole divided by, okay, whole divided by contribution, whole divided by contribution. Okay, profit contribution minus fixed cost. Contribution minus fixed cost will be called as what? EBIT, profit by contribution, or EBIT by contribution. So we know that operating leverage is contribution by EBIT. Therefore, operating leverage equal to 1 by margin of safety. Okay. Up to here, hope everyone understood the concept clearly now. Please copy the notes in this regard. I think you copied all these. From here, additional analysis you need to copy down the notes. So please copy the notes. So hope you completed writing. Next. So alternative understanding is also completed. Now we are going to learn about understanding the business risk and mainly business risk but also finance risk in turn in a different perspective. Okay, first listen, this is a different type of discussion altogether. Once after this is completed, notes writing will be there. So be patient while listening. Once you listen to all these things, now problems will be completed just in no time. So listen carefully. Understanding business risk in a different perspective. Okay, first point. Risk in our perspective is uncertainty of getting expected profits. What is a risk? I'm not talking about risk in life, etc. From the business point of view, what is a risk? We expect some profit. Not getting that expected profit itself we call as a risk. That's all. Risk in our point of view is what? Uncertainty of getting expected profits is a risk. Okay. So this can be analyzed as follows. Risk means variability in return. Return means a profit. Okay. Return on investment, like that you can understand. Okay. Risk of a company will be derived from two areas. Number one, from the operations, from the financing. From the operations we call as a business risk. From financing we call as a finance risk. Business risk will come from the nature of products or services or cost structure employed. Finance risk will come from the debt or equity proportions you are using. Sorry, I will explain you one point. Listen carefully. So hopefully you will understand this example in a right sense. So with that point of view, let's start. See here. What I said is, previous example. Okay. Existing and 10% increase or 10% decrease can also happen. Okay. First, listen carefully to the point. My sales is 10 lakh. My variable cost is 6 lakh. Contribution is 4 lakh, fixed cost 2 lakh, EBIT 2 lakh. This is what I am expecting. Say for example, not existing, it is expected. That 2 lakh is guarantee a bond paper written sales. Okay, any person said that definitely I will buy, you sell me. Is there any guarantee? Cost is guarantee, contribution is guarantee, fixed cost is only a guarantee. So there is only one guaranteed amount here, all the remaining are unguaranteed only. Because nothing we can give a bond paper guarantee that it will definitely happen. It can change. What I am expecting is 2 lakh. What actually happened is 2 lakh 40. What I expect is 2 lakh. What actually happened is only 1 lakh 60. Anything can happen or not. Why it will happen? Why that change will come? We expect something. It happens at different level. Why that happens? That variability in expectation is called as a risk. We are seeing only one angle. One angle. What is the one angle we have seen? We saw that sales 10 lakh, sales increased to 11 lakh. But we are not understanding what is the reason for that increase. We are concluding that sales has increased, but we are not going deep into the analysis why that sales have increased. Now we are focusing on that. Okay, we are now trying to focus on why sales have increased. Sales have increased is a conclusion. Why sales have increased is a reasoning. We want conclusions, we want reasoning, we want a reasoning, not conclusion. That reasoning we are going to analyze. The discussion what I am going to put now for the another 15-20 minutes is not there even in the study material. It's not there even in study material. Then where it is? CA final. But I am telling here for one good reason. My students should understand every single thing. It's not just understanding conclusions. They should understand from the scratch to the highest tip of understanding. So let's try to understand once again. Sales 10 lakhs are? Yes. Sales really 10 lakh happened. Let's say this is not existing, this is expecting. Actual happened is 11 lakh. We expected 10, we got 11. Expectation need not be always higher. Sometimes I expect 10, happened is only 9. That can also happen or not. Why that happened? Why your expectation is going wrong is a question. When your expectation is going wrong, you are having a risk, not having a risk, having a risk. That's called as a business risk. Now we are going to analyze that. If there is a change in sales, automatically the change in sales, variable cost will change, no problem. Contribution will change, no problem. But fixed costs don't change. Sale increased, I will be very happy because for increased sale, fixed costs don't increase. Sale drop, I will be very much unhappy because for the reduced sales, for the reduced contribution, fixed costs don't change. So fixed cost will make us laugh, will equally make us cry. Therefore, when fixed cost will make us cry, when the sales are changing, the change in the sales itself will be called as a business risk, because for the change in sales only EBIT will change. Am I clear? Percentage change in EBIT by percentage change in sales, operating leverage, also called as operating risk. Clear, everyone? So what is the conclusion that you have to understand? Changes will happen, okay, because of that EBIT will change. So sales 10 lakh, every year sales 10 lakh, government guaranteed us every year 10 lakh business I will give you. Then what will happen? Sales 10 lakh, variable cost 6 lakh, contribution 4 lakh, fixed cost 2 lakh, EBIT 2 lakh. Next year same, the next year same, 10 years after same. Now risky or no risk? No risk business, no risk business. Because for namesake this is variable cost, but actually government guaranteed you that variable cost is also a fixed variable cost for you. But in reality that happens? No. In dreams also this cannot happen. Therefore, always we expect something, but happening will be something different. That's called as a risk. If sales changes, automatically my contribution changes. If that change is on a negative side, my fixed cost will be more endangering me. Okay, so listen, why sales changes from our expectation is a question now. It depends on two things. Okay, why EBIT changes? Tell me, why EBIT changes? Because contribution changes. Why contribution changes? Because sales changes. But no one is asking a question till now, why sales is changing? EBIT changes because contribution changes. Contribution changes. Sir, what is the contribution before? 4 lakh. What is the contribution later? 440. What is the EBIT before? 2 lakh. What is the EBIT now? 2 lakh 40. Everyone know that EBIT changes because of contribution change. But why contribution is changing? Because of change in sales. But why sales is changing? No one is analyzing that. Till now, no theory has analyzed it. Later, one person has analyzed the concept called as a levered and unlevered beta CA final. I am putting that discussion here. Okay. So, therefore, EBIT changes because contribution changes. Contribution changes because sales will change. Contribution changes because sales will change. So, the emphasis and analysis should be on why the sales will change. So, sales will change because of two things. So, simply to understand, sales will change because of the change in sales, contribution will change, automatically EBIT will change because there is a same fixed cost. But why sales should change? Sales should change because of two reasons. Number one, the nature of goods or services you are providing, and EBIT changes. Or I can tell, instead of sales, I can tell EBIT changes because of two reasons. Reason number one, nature of products or services. Reason number two is the cost structure that is employed. Sir, I will explain this way. Listen, my company is in manufacturing or production or providing a discretionary service or discretionary goods or essential services or essential goods. I will explain in a detailed way. Listen carefully. There are two types of businesses, or there are two types of ways of doing a business. Companies which are involved in producing essential goods and services or discretionary goods and services. Okay, clear? EBIT change is the risk for us. Why EBIT changes? Because contribution changes. Why contribution changes? Because sales changes. Why sales has changed? Because my nature of goods or services. Say for example, my company is in the manufacture of essential goods like FMCG, toothpaste, soap, shampoos, etc. Daily consumption, cosmetics, etc. It is there. Say for example, let that be my company nature. Okay, COVID time has come. In COVID time, entire economy has a fall into a recession. At the time of recession, markets will not perform well. They will come down dramatically. There will be an effect on market. Now answer, people lost revenue, some people lost jobs. Now answer my question, will Hindustan Unilever market will get affected because of COVID or not? Answer is a big blatant no. Do you know why? It is an essential goods. Though the market, entire economy is in a recession stage, people will not compromise brushing the teeth. People will not compromise bathing in 2 times a day, at least minimum. Okay. People will not postpone consuming certain things. People will not postpone eating things. Those will run as usual. Means bathing, brushing the teeth, shampoo, all these are essentials. Whether market is in boom, whether market is in recession, does not affect the sales of that company. That's why if you observe always, Hindustan Unilever company, same products they will have. They will not have increased sales. They will not have decreased sales. Consistently sales will happen. At least every 8 out of 10 people will have a consistent using of a product or a service. For example, a person is using, say for example, Synthol. Wherever he go, even to a remote place he go, he will ask whether Synthol soap is available. If not available, he will go for an alternative. But if it is available, he will use only the same. Why? Because I have desire towards one product, means essential commodities I will use the same everywhere. Hope you can understand the point. Shampoo also same, toothpaste also same, toothbrush also same. Like that, so many things are there. For understanding, I have taken these lively examples. So the thing is, wherever you go, those essential commodities don't have greater sale, don't have a fall of sales. Consistently they will maintain. Say for example, COVID came, recession came in the market, boom lost, markets affected negatively. People started compromising on brushing the teeth, bathing 2 times a day, having a shower at least 2 days in a week. They made a compromise. No. Recession don't stop me from using essentials. And boom in the market came. Suddenly, COVID over, there is a market boom. People will start brushing 10 times a day. Na? People will start bathing 15 times a day. Na? So that also will not come. Means if your company is in essential goods and services, in market rise or market fall will not affect you so hardly. But if your company is in a discretionary commodities zone, say for example, my company is in automobile. If you remember, COVID time, automobile industry, real estate industry affected like anything, badly affected. 2 industries are, one is automobile, another one is a real estate. Try to understand. When COVID impact came in 2020 early, market don't know what is happening. You can't come out of the house. Complete lockdown. You are locked inside your home. Maybe 2-3 hours they have given a relaxation after 1.5 months. But first 2 months, na panic stage is there. So panic attacks came. So no one went outside. Triple layer, double layer mask. People used to go that way. Markets have got affected like anything, negatively affected. Adversely, market got affected. Okay, market got affected. Because of that, no one started buying any of the cars during that time. If 10 persons buy a car in a month, only 2 bought at that time. Why? People are not in a position to buy them because they don't know when their salary will fall, when their salary will come and deposit it. They don't know. They don't have a clarity. That uncertainty, recession is there in the market. People started postponing the purchase. What they thought, let the COVID get over, after that we will buy. Means there is a negative impact called as a COVID. Because of that, economy got affected or not? Yes. because of effect on economy, automobile is got affected more greatly. That means beta of this company product to the market is very high. Beta means just change, rate of change. Okay, if market is affected negatively, automobile will get affected 10 times more. Real estate also same. This is how it happened. So my company, if it is in essential commodity zone, though there is a fall in the recession or though there is a fall in the economy overall, my company will have a stable sales. It don't have excess sales during boom. It don't have damaging sales during recession. It will have a consistent sale. Okay, if your company is having a consistency in its sale, irrespective of whatever happens in the market, such companies can employ fixed costs, because such company will have a stable sales, stable variable cost, stable contribution with a stable fixed cost. They can guarantee a overall average, a basic level of EBIT they can guarantee. But if your company is in a discretionary commodity, try to avoid fixed costs as much as possible, because higher the fixed cost, automatically Maruti is there. What is the difference between Maruti and all the other companies? Other companies, okay, their factories, everything is a leased premises. Maruti is having its own premises, means a fixed cost it avoided. That's why Maruti is successful during the COVID time. All the other brands have cried like anything. They wept and screamed. At that time, Maruti was happy because of what? Fixed costs are not there for Maruti. Even in that case, CA industry you take, okay, people who have hired premises affected like anything. People who have own premises, they were very happy because they don't have fixed cost. Even one class is sold during a day also, they are very happy. Clear everyone? So therefore, if your company is in manufacturing or production or providing essential service, then you are safe. Risk is very low. Even you employed fixed cost, nothing will happen, because you will have a stable sales and contribution. Okay. And if you are in a discretionary area, change in sales will definitely affect the EBIT. Furthermore, if you have debt in your capital structure, you are gone. So therefore, try to understand clearly. Okay. So it is clear that the nature of business you do will decide about the risk of your business. So business risk will emerge from the nature of business. If your nature of business is essential, sales will not change. When sales don't change, contribution don't change. When contribution don't change, EBIT don't change. So EBIT changes because of another reason, which is not goods and services you produce, that is your cost structure. As more and more fixed costs are loaded into your cost structure, risk will increase. Okay. So one important point you need to understand here. Always you should understand, business risk is the source of all the risks. Finance risk is not the more riskiest thing. Business risk is the more riskiest thing. Do you know why? See here. EPS changes because EAT changes. EAT changes because EBT changes. EBT changes because EBIT changes. Why EBIT changes? Because contribution changes. Why contribution changes? Because sales changes. Means if sales don't change, it don't affect EBIT. Change in EBIT to the change in sales is called as an operating leverage, also called as operating risk. So if this change itself is not there, if EBIT don't change, EBT don't change. When EBT don't change, EAT don't change. When EAT don't change, EPS don't change. When EPS is not changing, no change means no risk. So the entire finance risk means change in EPS for the change in EBIT. If EBIT don't change, how EPS will change? EBIT 2 lakhs. Next year also 2 lakhs. Then what will happen? Same 1.867 you will get. Okay. So what you have to understand here, EBIT is the source of EPS. Sales is the source of EBIT. That's how sales EBIT change has become operating leverage. EBIT EPS has become financial leverage. That's how operating financial leverage as concept came. So what is the source risk? EBIT is the source risk. What is the destination risk? EPS is the destination risk. On that only I have given complete analysis. So please write down the notes, copy the notes. And by the way, one last conclusion is, see here, summary of risk: business risk, finance risk. Business risk: nature of products and services, cost structure. So essential, sigma symbol means risk. Risk is a symbol of sigma. Essential means lower risk. Discretionary means higher risk. Fixed and cost structure: more fixed cost, more risk. Less fixed cost, less risk. Variable cost: more or less doesn't have any change because it changes according to the changes in sales. So the conclusion is very important. Low operating leverage, low financial leverage, lower total risk. High operating leverage, high financial leverage, very risky business. High operating leverage but low financial leverage. Try to understand, high operating leverage means obviously financial leverage will be affected. So moderate. Low operating leverage but high financial leverage is the best combination. So put your fixed cost as less as possible and take debt. About that only we are going to see in capital structure theories. Okay, now write down, make it fast. So pause it, put the screen in a pause and write down the notes. Okay, I'm closing the video here. Next lecture will be followed by solving the problems. 1.5 hours will complete leverages. We'll go into the next chapter called as capital structure theories. Okay, in capital structure theories, we are going to start first with the EPS indifference curve. Okay, EPS, EBIT, EPS indifference concept is there, that we will discuss. Later we go to basic capital structure. 3 classes for capital structure, 3 to 4 will complete. Then full-fledged capital budgeting we will jump into. Thank you.